Okay, the S&P rebounding with the PCE inflation data after a few days of a losing streak, but it also snapped a winning streak in the weekly time frame. I showed you the candlesticks, what I was looking for. We'll take a look at them in just a few minutes. First, the Dow was up by almost 300 points, just a fraction under it, 0.65% higher. Dow recently got a topping tail in the daily time frame, and we'll look at that. The S&P rebounded by 0.59%, up almost 39 points to 66.43. The Nasdaq was up 0.44%, and the Russell was up just under 1%. The VIX was down 8.66% to close at 1529. This week we got important information. Earlier in the week, again, we saw jobless claims come in less than expected. Before the Fed rates, they were at 263,000. Now they're dramatically dropping. If we see the jobs report improve next week, which I think that that's going to happen, then traders are going to call into question whether the Fed will give us two more cuts later this year at the next two meetings. I told you, it very well could be a one and done, and those cuts could be taken off the table if we see inflation data rising. I'll be watching the CPI next month, and if we see the labor market improving, then why does the Fed need to cut? Now, the Fed should be cutting because we're moving into recession. They should be slashing rates right now, not because we're moving into a golden age. Trump's hoping for the rate cuts to have this really good economy. He's going to be surprised because we're going to get Trump's rate cuts. He's going to get them, but it's going to be because we're moving into recession. The yield curve is telling us something is wrong with the economy. Other recession indicators. So saw the jobless claims go down to 218,000. We saw the GDP, third estimate, sharply increased. It was supposed to come in at 3.3%, hold steady as it was before. It came in at 3.8%. Again, the Fed cited the weak GDP and the weak labor market for the excuse, this is what Powell said at Jackson Hole, for the excuse to shift the balance of risks, to justify the cut. Now we're seeing the GDP grow at the fastest pace in 2 years. If we see improvement with the labor market, as we're already seeing with the jobless claims dropping down to 218,000, coming in better than expected and much lower than what they were right before the Fed cut at 263,000, why does the Fed need to cut? Especially if inflation starts ticking back up, which it already is. So again, we had that earlier in the week. I talked about that Thursday. And then we have the durable good orders. 2.9%. It was supposed to be a negative number, negative 0.4%. Previously, it was negative 2.7. So again, a positive, good, strong number. So does the rate cuts, the next two being penciled in, do they end up getting taken off the table? We had the inflation data come in on a Friday. The inflation data, month-over-month basis, came in line with expectations. Year-over-year basis, the headline number came in line with expectations. No surprise with the headline number 2.7. It came in as expected. And also with the core year-over-year 2.9 as expected. And that's the same as before. So again, get a hot report, but it came in as expected. So the market's got a relief rally on it. This week we'll be getting some housing data, but the jobs report and the private payrolls are going to be looked at very carefully. The private payrolls right now are expected to come in at 40,000, lower than the 54,000. We're going to get that October 1st on Wednesday. The jobs report is still supposed to be weak. The estimate is 45,000. It was 22,000, so we're still seeing a weak number. Now listen carefully. If this comes in stronger than expected, markets can sell off. If it comes in weak, extremely weak, the markets could sell off. Why? Because concerns about recession. I'm telling you that we could see labor market data begin to improve as we did right before the 2007 recession. The number went negative. It started to improve, and then we got a big negative number, and the market peaked after new highs. We'll be watching to see, does this number come in weak and rattle markets really weak, or does it come in really strong and rattle markets? Either way it comes in, it's a lose-lose situation. Either markets will be concerned that we're moving now into recession and could sell off, or number's strong and we're rebounding with the labor market, so why does the Fed need to cut? Cuts are going to be taken off the table. We'll be watching to see how this comes in. Now it's expected to be 45,000. The unemployment rate is supposed to hold steady. Unemployment rate is supposed to hold steady, 4.3%. And I think we're going to sell off until earnings season into October, and the stock market likely to play catch up with Bitcoin, which triggered all kinds of sell signals at the August peak and then again at the September high the day after the Fed meeting. Bitcoin peaked and began to tank, and it's dropped sharply since then. The stock market and the Nasdaq, S&P are going to play catch up. Now, in the weekly time frame, we're forming candles of indecision. Dojis, spinning top candlesticks. You got it on every single one of the averages, the S&P, the Nasdaq 100, the Dow, and the Russell, all getting candles of indecision. Candles of indecision either mean continuation or reversal. It's likely going to be a reversal. We're hitting this trend line on the Nasdaq, and a major trend line of resistance on a couple of them on the S&P 500. Actually hitting 3 trend lines on the S&P and reversing off of it. Shorter term and 2 longer term trend lines. This trend line, going back to the 2020 low, we bounced off of it here during the 2022 sell-off. We bounced off of it, gave us a lower high when we broke it. We've come back up to it. July, we turned off of it. We dropped nearly 16% in July of 2024. We hit it in December of 2024. You sold off a little bit there. You rebounded. You went slightly higher. Not reaching the trend line, but slightly higher than the previous peak, and then you got your sell-off of nearly 26%. It came in just over 25% or so, just rounding it to about 26%. I believe that's what it came in, right around that level. Every time we hit this trend line, bad stuff starts happening. Now we're hitting it again, and we're getting a candle of indecision. I'll show you up close and personal in a moment. If we just get a drop like this, the 16%, it takes us back to the 200 period moving average, I believe beyond the 200 period moving average on the Nasdaq. Keep this trend line in mind when I show you the bars up close. Then on the S&P, we have 3 different trend lines. Let me just fix this. My trend line moved on me here. We have the trend line from the 15-minute chart and the 60-minute chart. We just turned off of a rising wedge. That was the run-up in September. We have 2 longer-term trend lines here. Now here we have the blue trend line, this lower boundary. I'm connecting this low and this low right here. Didn't reach it here, didn't reach it here. Just connecting that low to that low with the bottoming tails. Parallel boundary to the 2018 high, connected to the peak in 2022, and that pushes up to right where we're at right now. Okay? Personally, I think we're going to turn here, and then I think we'll eventually go to the red trend line, which is this trend line here, excluding the shadow, touching this low right here, our 2023 low. So you've got the bottom in 2020 connected to the 2022 low, connected to the 2023 low, connected to the April 2025 low, and that's the red trend line. And that is channel I think is in play, and we also bounced off of the horizontal support, and that's why I called a bottom in April. Massive support. So again, you're hitting the parallel trend line of the blue trend line. The red trend line is still a little bit higher. And we're also hitting, this is our linear scaling, the trend line from the 2023 low connected to this low right here. We slightly exclude the shadow there in the daily time frame. We slightly overthrow that level. In other words, the trend line moved slightly beyond it. But if you connect this low and this low, that's the low that's the level that we're slamming up into. If you include this point and this point, we were hitting it. We were straddling along that trend line, but broke above that one. And now we're hitting this trend line right here. So still an important trend line. And it intersects with this upper blue boundary. So this is where we're at on the S&P. So we're getting the trend line from the high of 2018 connected to 2022. We're slamming into that. And the trend line from the 2023 low, slightly excluding the shadow here, and connected to this higher low that formed between the December 2024 peak and the February peak that we had in 2025. So there you go. We're at these trend lines. And the trend line that we turned off of in the intraday time frames. This is the rising wedge from the September low there. We rallied up and we got a rising wedge. You're not only slamming into this trend line of resistance, but you're slamming into the trend line from the 2023 low. You're slamming into the trend line from the 2018 high on the S&P 500. As we're slamming into these resistance levels on the S&P, on the Nasdaq. Nasdaq one more time. Again, that trend line, long-term trend line from the 2020 low and the broadening formation. That's the upper boundary of the broadening formation. Here's the trend line up close with their broadening formation in the daily time frame. We've slammed right into it after reaching trend line from the peak in July of 2024 and December of 2024, slammed right into that trend line, and that's where we've stalled out. Now this trend line right here from 2020, the 2020 low, is our linear scaling. On our log scaling, we have another trend line with the NASDAQ. That's our trend line from the 2023 low. Our log scaling on the NASDAQ, and again, that's connecting this low here to this low right here, and we came up and we stalled at it previously in August, turned down, went back up here, overthrew it just slightly last week, closed right at it, just slightly under that trend line this week, getting a candle of indecision. By the way, on the NASDAQ weekly chart, the stochastic is formed negative divergence. We've gone higher. The stochastic has not. And also on the histogram, for the MACD, there's also a negative divergence present here in the weekly time frame. Now, as we're slamming into these different trend lines, we're getting these candles of indecision. Now, this is the NASDAQ weekly chart. As we're slamming up into that trend line from the 2020 low, hitting the upper boundary of the broadening formation, you're getting this candle of indecision. I talked about this earlier in the week. I told you, again, if we ended up rallying back up with the PCE data, you could get spinning tops or dojis, and we saw that happen. We had a losing streak and a rebound back up to give us these reversal candles. This is NASDAQ weekly chart down 0.5% for the week, down 122 points, breaking the 3-week winning streak. NASDAQ 100 weekly chart. S&P weekly chart as it's slamming up into the trend line from 2018, hitting the upper boundary of that potential channel, hitting the trend line from 2023 low, hitting the upper boundary of the rising wedge. You're getting this spinning top doji looking candlestick. Again, we were down for the week, breaking the 3-week winning streak, our run up off the 10-week moving average for the S&P, for the NASDAQ. S&P was down 20 points, almost 21 for the week, down 0.31%, getting this candle of indecision. So now we have these potential reversal bars or candles of indecision. Previously, we got it over here. It was a continuation before the September run-up. Dojis or spinning tops are either continuation bars or reversal bars. S&P weekly chart here as we're hitting these resistance levels. Again, I told you we were going to see a post-Fed sell-off. Had options expiration right after the Fed, and I told you going into the Fed meeting, the rate cut is already priced in, and we're going to see a sell-off, but we also had options expiration, might be a post-Fed sell-off. Bitcoin got it immediately. It topped the very next day after the Fed meeting, and it began to sell off sharply. Stock market started it this week, likely continue going forward in the coming weeks ahead, probably down, moving towards the 20-week moving average, the blue line right there, or the 50-week, probably beyond that, a bigger sell-off. Candles of indecision, NASDAQ and S&P, we got spinning top looking candlesticks. You almost classify that as a doji as well. It's the opening bar and the closing bar was less than 10 points apart. So again, little spinning top or doji looking candlestick on the S&P. Clearly a spinning top on the Nasdaq. What looks to be a shooting star candlestick for NVIDIA. You got this real body here and this topping tail here. That's a shooting star. We rallied up and the rally was given back. You're still up, but we went back up to just a fraction above the previous high and reversed sharply back down to the 10-week moving average. A topping tail here, possibly a sloppy shooting star, a little bit of a lower wick there, or again, a large spinning top kind of looking candlestick. This is NVIDIA weekly chart. Oracle had that big rally. It was down 8%. It gave back the rally. This big move on Oracle. Seeing distribution resistance levels on Oracle and on NVIDIA. The topping tail on Oracle over here. Now look at this one right here. The Dow is down 0.15%, down 67 points for the week. The Dow gets a doji candlestick. Again, the open and close very close to one another. The Dow slightly lower than the previous week's close, but it closed above the open for the week. Still down for the week, and that gives us a doji candlestick for the Dow. The spinning top over here was a continuation. This is likely going to be a reversal. Look at the daily time frame. The Dow got a topping tail, a shooting star candlestick on Tuesday at the beginning of the week. That got confirmation and a follow through, but we bounced out the 20-period moving average. We're going back up now, attempting to fill some gaps. Massive warning sign is the Dow Theory reversal signal here on the Dow transports. The Dow moved to new high, and this is the weekly chart again, getting that doji there, getting a divergence. We moved to new highs, divergence with the transports. It didn't make new highs. And again, the transports peaked way back in 2021 and hasn't been able to have this massive larger divergence between the two. We go further back, Dow's moved to new highs, the transports has not. But you've got a divergence in the most recent price action. This is a massive warning sign. The Dow is moving to new highs. The transports are not moving to new recent highs. They're not moving to new highs, period. They're diverging from one another. This often happens at turning points. At the April low, the Dow made a higher low above the 2023 low, whereas the transports made a lower low and they diverged, and that marked the bottom. I talked about that back at the time when we were seeing the bottoming signals on the S&P and Nasdaq at key horizontal support along with Bitcoin. This is a huge, huge problem for the market. Now getting a topping tail in the daily time frame on Tuesday, a shooting star, then getting a doji for the week with this divergence with the transports. It's a massive red flag that the doji is likely going to be a reversal pattern rather than a continuation pattern. You have the Dow Theory sell signal, which again, this is one of the components, I should say one of the tenets of Dow Theory, is the principle of confirmation. The averages have to confirm each other, and right now the transports are not confirming the Dow's new highs. They're making a lower high, and that's usually when the moves fail. Some huge red flags out there. Candles of indecision in the weekly time frame, which I told you could form by the end of the week. Earlier in the week, and we talked about that, and I showed you those charts. On the Dow, the S&P, the Nasdaq, and the Russell. Got the Nasdaq and S&P slamming into resistance, and then you've got this Dow Theory reversal signal here in the weekly time frame between the Dow and the transports. Declines on the S&P 500 have been back in July of 2024, almost 10%, and then after the February peak, we dropped over 21%, almost 21.5%. If we were to drop 10% from the levels where we're at right now, if we were to peak with the doji in the weekly time frame, or spinning top, really qualifies as both, but if we were to have that be a reversal bar, we were to drop towards the the same amount of levels that we dropped back in 2024, the summer of 2024, 10%, nearly 10% drop takes you back towards the 200 period moving average, but beyond the peak made in February right there. So again, another level I'm watching there. But the 200 period moving average here in the daily time frame, that would take us back towards where that is right now. It'll be higher even if we come down. The 200 period is going to still rise. If we get a sell-off from what we had with in February of 2025 down to the April low, over 21%, I have marked that over here, and you are looking at a much bigger drop if that happens. Now, my guess is we don't get that kind of bigger drop right now. I think we get a more mild drop. But if we get a bigger drop, that drop from the levels we're at right now, I've marked that over here, that would take us down to towards the 78.6 Fibonacci, towards 5,200. If we get a more mild sell-off, 10% sell-off like what we had back over here, then you're looking at a moving towards the 38.2 Fibonacci at just below 6,000. Below that, we have the 50% retracement at just below 5,800. 61.8 fib at 55, the 55.50 area. So again, if you get something bigger like this, then you're going to reach the 78.6 Fibonacci. I don't think we do that. I think you're going to pull back, and then I think you're going to try to go higher, and then I think you're going to top in the coming months ahead. If you get something similar over here, then watch the 38.2 Fibonacci at just below 6,000, 59.95. Or 200 period, we could move back towards the 200. Maybe we don't reach a 38.2. Maybe we come to just wherever the 200 might be as it's rising, or just above it. But if you drop below it, I'd be watching the 38.2 Fibonacci. Now, I've done the same thing here for Nasdaq. Nasdaq, again, here's our broadening formation. From the 2024, July 2024 peak, we dropped almost 16%, 15.79%. You get a similar drop to that right here, right now. If we peak at this trend line, then you're looking at a move down. Let me just move this over here so you can see it. You're looking at a move down towards the 50% retracement under the 200 period moving average. If we get a nearly 16% drop, a 15.79% drop, that takes you closer to the 50% retracement, takes you beyond the high over here from the February peak. It takes you beyond the 200 period moving average. It takes you beyond the 38.2 Fibonacci at 21,660. If we get a similar move to this, you're still looking at a pretty hefty drop that could take out the 200 period moving average if we do get a nearly 16% drop. That will take out the 200 period moving average. If we get a more mild sell-off, you could hold above the 200, or as it's rising, you could find support at it, maybe near the 38.2 Fibonacci here, or at this peak right here, just closer to that 200 period, slightly under it. But here, as it's rising, you'll get a bigger drop if you get something similar to what we had over here. Now, with this drop right here, and I don't think this is going to be the case, but this was from the February high. We dropped nearly 26%, 25.86%. And if you get that same type of drop right here, that would take you 25, almost 26% lower. That take you here towards the 78.6 Fibonacci, towards 18,300. So again, that would be if we got something more dramatic. Personally, I think we're completing wave 3 and going to get wave 4. We get confirmation of that. We get confirmation of the doji highs this week and the spinning top candlesticks. If we get confirmation that that is the peak, everything beginning to turn bearish, we can begin a pullback that I think will be wave 4. And then I think we'll go up and hit this trend line one more time for wave 5. So again, we'll be watching our Fibonacci retracements. But again, if this high holds, if the doji for the week and the spinning top on the NASDAQ and the doji for the S&P holds, then I'll be looking at the 38.2 and the 50% retracement for a more mild pullback, or above our 200 period moving average, or above or at this February high. And then the deeper pullbacks down here, the 61.8 Fibonacci and the 78.6 Fibonacci, I think is less likely. I think we're going to get more of a mild pullback. I still think it will be, I think, bigger than what we've seen so far, but still not something that's probably going to come down and get something deeper or to take out this low. I do think we have a broadening formation. My guess is it's not done. I think you're going to sell off and go back up and hit it one more time. I think the fourth quarter is going to end up being good, but we're way overbought and again likely going to reset going into October here, and then you'll get an October bottom in all likelihood. Again, over here in just a few weeks, we dropped and said 3 previously. It ended up being 4. I said that yesterday. In about 4 weeks, we ended up dropping nearly 16%. You could drop in a few weeks, 2, 3, 4 weeks. You could end up getting a significant drop. We start seeing big ugly red bars following our doji and spinning top candlesticks in the weekly time frame.